Well, welcome everyone to a very special masterclass that likely will represent our greatest lifetime financial risk. We'll also be taking over 10 hours of wisdom and packing this content within 45 minutes while making it much simpler and easier to understand. Just to give some perspective so everyone knows, tax planning is a lot like playing checkers where you're reacting one move at a time, and often that move is too late, like around April of the year after. But tax management is like playing chess, which means you're moving 6 to 7 moves ahead. And you'll see why that can give you a huge advantage in a rising tax environment. Now, to make this possible, I really want to just thank some of our special friends, David Alison from Alison Wealth Management, our other friends from Clarity to Prosperity, Professor Chris Worley, who teaches tax law at Villanova University, and also has taught at the American College where I did my master's. Lastly, I don't want to forget our friends from Madison Main Advisors and our special guest here, Charles P. Welde, a CPA and certified financial planner and founder of the CP Welde Group. So with that said, Charles, welcome and thanks so much for being here.
Frank, thank you. And I'm really looking forward to today's presentation.
Definitely we all are. So let's start by addressing some of the top tax cuts, if you remember, from 2017. It's very relevant here. If you remember, we had lower tax rates, which meant that a 15% to 50% bracket was paying 12 and zero capital gains. The 25% bracket was paying 22. And the top tax bracket went from 39.6, for an example, to 37%, which was a lower tax for people who didn't have as much investment income, and we'll tie on that later. The second one, a higher standard deduction, along with elimination of personal exemptions. Just so everyone knows, that was especially good for lower to moderate incomes, but not as good for maybe those who itemize and like to write off some of their charity donations. And I know there's another thing you talk about a lot, Charles, the SALT deduction. Can you just explain real quick what the SALT deduction means and how that affected, let's say, higher income taxpayers?
Yeah, so the SALT deduction really, limits the amount of taxes you can deduct on your personal return. So, in the past, I mean, you had husband and wife working, maybe making good salaries, and maybe their state, local taxes were, north of 10 grand. They had real estate taxes, so they had a pretty large deduction. And now that, it's capped at 10 grand, the problem is, they're actually have lower deductions and higher taxable income because of the SALT deduction being in place.
But the third one, my favorite, I guess my preferential one, is the 20% qualified business income deduction. That pertains to anyone except for those, I believe, in the 37% tax bracket. I think it was a good incentive for government to collect a record level of revenues while incentivizing small to medium-sized business owners. Any thoughts you have on that one?
Well, I mean, obviously, it's kind of a free deduction, 25% of your qualified business income. So in the past, where you really had to maybe overfund your 401k or, IRAs, this kind of makes it a little bit easier because you got that, that deduction that's kind of automatic since 2017.
Correct. And let's turn and move forward now to two issues here. That's the IRS Secure Act 1.0 and 2.0, which really has transformed a lot of, financial and estate planning. And we'll touch on that real quickly. The first one being the Secure Act 1.0, which was changed at the end of 2019. I think the big issue here is, number one, there's no more stretch IRA, formerly considered, as your friend Ed Slott would remind us, the second best benefit in the tax code. Why? Because it simply allowed anyone in any high tax bracket taxpayers to shift their retirement legacy to children and even grandchildren in lower tax brackets. All right. Any thoughts on that one?
Well, there's a lot of trusts set up, like IRA trusts, that really need to be reviewed. And the reason being is in the past, the language was great, really kind of like dictating how those funds would be paid out to the beneficiaries. Today, with the new rules in place, non-spouse beneficiaries have to clean that IRA out within 10 years as a general rule. And if the language isn't changed, maybe some people might have to take that money out, not over 10 years, but over 5 years.
Oh, you mean because it's a non-person beneficiary at that point, if the language in the IRA inheritance trust, for instance, doesn't comply with the new 10-year rule. Is that correct?
That's correct. Absolutely.
Wow, that's a great point. I'm glad you made that point there, because the purpose of that, which became very popular before 2019, was so that way not only could wealth be managed and stretched to the next generation and beyond, but make sure there weren't any lawsuits, any divorces, or any predators basically that were going after those assets. So just so everyone knows, the Stretch IRA was such a great estate planning tool. And now, as we mentioned, even here on the second point, that life insurance apparently has replaced that to a large degree. And I think your friend Ed Slott reminds us as well that life insurance has now become the second best benefit in the tax code. So we'll probably tie on that a little bit as we move along. The third one here, I know with the Roth IRAs, the big one was not being able to, I recall, undo the Roth conversion by the tax filing date. All right, I remember that was a real great advantage. Even I did that in 2010, where I aggressively took more assets than I expected to convert into a Roth, knowing if there was a down market, I would be able to just unconvert some of that and not have to pay a higher tax on a lower amount and then do it again later. So they
Right.
did get rid of that. I thought that was a great advantage. It was almost like being at a roulette table and saying, hey, I'm choosing the color red. Then black comes out and say, no, I changed my mind. I don't want to take that bet.
Exactly.
And
Good point.
luckily, in hindsight, the markets did well that decade after 2010. Some of it was the recovery, of course, and a lot of people who smartly did that, like even ourselves, we made up in gains beyond what we paid in taxes to shift into a tax-free environment. And with that started, Charles, we want to take one at a time. Tell us the first one on there, and then I'll go right after you.
Yeah, so traditionally, if you were 70 and a half, you had to take your RMD. Now they're extending it to age 73 if you were born, between 1951 and 59, and age 75 if you were born in 1960 or later. And on the surface, it appears like, why are they doing this? They really want you to pass away with a large IRA so that your kids or grandkids will inherit it. And, for the most part, most likely be in a higher bracket, adding that income to their wages or W-2 wages.
Right, great point there. The second one, obviously, reducing the penalty for missed required minimum distributions from 50% to 25% and possibly 10% if fixed in a timely manner, which means they got to you ahead of time. So even your firm could fix that quickly.
Yeah. The third one allows employer matching to the Roth account. In the past, the employer matching had to go in the traditional account, the pre-tax account. Now they're being a lot more flexible, and for the most part, that's a great benefit.
Excellent. The next one, just so everyone knows, you're able to increase your contribution to a QLAC, which is a qualified lifetime annuity contract, from 145,000 to up to 200,000. Just so everyone knows, if you're over 70 and a half and you want to reduce your balance that's subject to unneeded required minimum distributions, that could create some tax traps in your own situation, which you may see in a little bit later here. You can take 200,000. Well, that would be parked into what's called a deferred lifetime annuity, which also would offer guaranteed higher payouts, which, by the way, reduce longevity risk, which I know is a relevant thing to our bucket planning process. Next one, Charles.
Yeah, then they increase the retirement plan catch-up contribution for people aged 60 to 63, in 2025. And what that means is, like, a lot of people are underfunded in their retirement plan, so they're kind of raise the limits to get them to maybe be self-sufficient in their later years.
And thank you for that clarification. I want to remind everyone that some of the language that the IRS first came out with this was very gray and it wasn't clear. I think they're trying to revise that. So we're just giving you bullet points that are changing, and hopefully they'll continue to clarify some of their language, which brings the next one. It creates an option to use a Roth SEP IRA or a Roth Simple IRA. So again, people, especially with more assets and a lower tax rate, marginal tax rate, can then start to build more tax-free wealth for when they will be taxed more later.
Yeah.
Next one.
Next one allows for a $50,000 IRA charitable rollover that you can put in a charitable gift annuity or a charitable remainder trust. And, the reason for that is a lot of people, as you mentioned earlier, aren't itemizing as they used to in the past with the large standard deductions. So that gives them an opportunity to, really take money out of their IRA without being taxed on it.
Yeah, and personally, I just want to add, I think if you already have any kind of a charitable remainder trust, that would be a potential advantage. if you're starting from scratch, I think you want to consider the costs and weigh that out as well. And,
Good point.
and the last one is allows for moving up to $35,000 in a 529 plan into a Roth IRA based on your annual contribution limits. It's got to be for the same beneficiary, which didn't look clear in the original language. And that's starting this year. And the account must have been in place for at least 15 years. Even if there was only $1 put in there at least 15 years ago, that's what you need to have to be eligible. Now, you might wonder, like, geez, how are taxes going to be raised on us? Let's just take a quick glance, if I will, on just what the highest rates are. You might wonder, how can we raise taxes when we're already feeling clobbered by all these rates? You know, we get taxed from every which direction. That's why I know your friend Ed Slott, I keep mentioning him, since he's such a leader in this area. He keeps reminding us that future tax increases represent the greatest detriment to your retirement dream. And he repeats that a lot, so I know he's right on track there. So any thoughts you have on these rates?
I think taxes are definitely going to go up, and these are rates, although they're the highest rates that you're showing. There's definitely some opportunity for people to, manage their taxes throughout their lifetime.
And great point. And part of that problem is our government, which David Walker, the former controller, reminds us, and he's such a factual guy too, that the real problem comes down to a four-letter word, which I can say here out loud. That's math. All right. The math. And let's just compare on a cash basis, because that's what the government operates on a cash basis. And just so everyone knows, the government's like an insurance company with a side business in defense. And I'm often reminded that any insurance company that operates on a cash basis is a disaster waiting to happen. All right. So let's walk through real quick, if you don't mind. You know, here's a cash basis math problem. In 2022, government collected, rounded out, $4 trillion of revenue. They spent 7 trillion. Wow. And which was a deficit of rounded out at 3 trillion, which meant that at the end of 2022, the national debt on a cash basis was 32 trillion. Now it's going in the 34 range and higher. All right. Again, compare that to a household budget. You know, you go home and you say, let's look at the books. Where do we stand here? All right, we're bringing in 40,000 of income. We're spending 70,000. Whoa, time out there. We need to stop spending so much money. And that gives us the $30,000 in the hole we got to get from somewhere. Now, normally a family would say, all right, we can't tap into the home equity. Let's see what we have on the credit card. Well, wait a minute. At the end of the year, your credit card now has $320,000. You know, first of all, I'm shocked that anybody would get that much credit. And the problem here is in a house, you can't go down a basement and print money like our government does. Would you say, Charles, there's a problem here?
Yeah, there's definitely a math problem. I would agree.
And the big question I often ask then is, if this problem has escalated to this point, was it this kind of spending reaction to the pandemic, or did we already have this kind of problem before the pandemic?
Yeah, this problem existed long before the pandemic.
So let's look right before the pandemic. And this time we're going to look at Truth in Accounting and what they thought on an accrual basis, the real way you should report future liabilities. All right. I really was taken back by this. You'll see here in 2019, government's future liabilities increased by a whopping $8 trillion, which meant that, just if you follow me here, the outcome was $113 trillion shortfall, which broke down the burden to each taxpayer. That's not just everyone that pays taxes. Half the country don't pay taxes. That's 737,000 per taxpayer. And I think, Charles, if somebody knocked on your door and said, hey, I'm with the IRS, number one, you owe $737,000. You're also going to have to kick in for, 90% of your neighbors that can't really pay anything. You're going to have to also pay for them. How would you react to that? What would you tell clients?
Yeah, I don't know. I mean, I probably wouldn't, I probably would slam the door, get upset. But the reality of it is, and you made a good point. This is the accrual basis of accounting. This is what the government owes to pay their bills. Everyone looks at the news and thinks it's 34 trillion today, but it's north of 113 trillion. I can't even fathom that. So we got a major problem. I hear, I see right the screen in front of me, the grade is F. If it's possible, I give them an F minus.
Yeah, I definitely do the F minus. I gotta agree with you there. All right. So then the question becomes, Now, how do we take control and manage to fix this? Just knowing the fact that the government really has two choices. Do you see any reduced spending, or do you see more spending?
I mean, I see more spending with what's going on in Congress today, but like at some point in time, it's probably going to be a combination of both. They're definitely going to have to reduce the spending.
And to understand that, let's put in perspective the history of tax rates, the highest tax rates. Okay. I get a kick out of this little chart here because clearly we're currently among the lower historical tax rates compared to, let's say, the 50s, when 90% was the top marginal rate for anyone over $200,000 of income. This goes back to a time, if you remember, when Ronald Reagan, who only worked 6 months a year because he had to stop doing any movies for the rest of the year, he would then just pay the 90% to the IRS. And then whatever's left over, when you think about it, pay 13% to the state of California. Now, think about that. Ronald could have ended up owing money for working the rest of the year. So if you were doing this kind of tax management for him, would you have supported him only working half the year?
Absolutely. I mean, if he works the second half of the year and makes just as much, he's really working for the government because 90% marginal rate to the feds and 13 plus to the state of California, it would end up costing him money.
So no further ado, let's jump to the exciting stuff. Step number one, understanding the order of money. All right. This is a reminder, Charles. I think you always repeat it, that not all money is taxed the same. I think the next slide is a great example. All right. You can see here we have three funnels here. You have pre-tax, which is mostly IRAs, 401ks, post-tax, which could be your brokerage accounts, real estate properties, and things like that. And of course, your tax advantage, which Roth plans are obviously a huge factor there. And how you manage over cash value life insurance is another one. Charles, where do you see that most clients, and you've examined this for a long time and you got so much wisdom and experience in this area, where do you find typically they have most of their money in which funnel?
Yeah, so the bulk of the people that we meet here in our practice have, a large amount of money in their pre-tax funnel. And, we were always taught, like, put money in, get the tax deduction today, and we'll be in a lower tax bracket when we retire. I'm not so sure that's a fact anymore with the way that the economy's going and how the government's like managing our finances.
Right. And just so everyone has a clear understanding of how they're taxed here, if we put 50,000 in the pre-tax funnel and took 100,000 out, we would be taxing all of it, correct?
Correct. Yeah,
And if
absolutely.
we put 50,000 in post-tax and took 100,000 out, assuming nothing else changed, 50,000 taxable, not 100, correct?
Yeah, you're only taxed on the growth of that post-tax account.
Correct. And in the tax advantage, if we already paid tax on the seeds on 50,000, wouldn't the $100,000 harvest be completely tax-free?
Completely tax-free. And that's really like, it's like baking a cake, like let's try to get each client the most efficient, group of funnels depending upon the facts and circumstances that they have.
And that brings up another appointment you made recently. I've always tapped into you for wisdom and things, and you provide so much of it, not just to your clients. I'm just glad to learn so much from you. But in a rising tax environment, which again, I said earlier, it's the math that factors in here. Would the pre-tax funnel be more valuable or less valuable in a rising tax environment?
In a rising tax environment, everything you have in the pre-tax funnel becomes less valuable.
Because that has a bigger liability and less certainty in terms of how much wealth you then control, correct?
Absolutely. Absolutely.
Well, wouldn't that mean then, conversely, the tax advantage funnel would become more valuable in a rising tax environment?
Everything you have in tax advantage becomes much more valuable in a rising tax environment. Correct.
And you've been preaching a lot of this even before I think it was acknowledged that we're facing inevitable rise in taxes. You were always passionate about this ahead of time. That's why I even like to think of you, as I said earlier, as a chess player. You do things several moves ahead. And in this case, I'm really thankful that you've instilled so much of this to a lot of people.
Yeah, I mean, other people have mentioned it. It's so true. It's not what you make, it's what you keep. And if you've got tax liabilities to pay, that really eats into your overall return.
Exactly. That's exactly right. And if we're going to go by what we keep, the next best thing is obviously step two, which would be let's measure it. Let's measure our marginal tax bracket to actually have some predictability in what we will keep. With that said, I like to go right to this nice picture, the married people to the right, single people to the left. These are the marginal tax rates after applying the standard deduction, just so everyone knows. Charles, first tell us why green is good. You love green. Tell us
Yeah,
why.
I mean, green is good because realistically, the top marginal rate you'll pay is 12%. So if you get to keep 88 and they get 12, that's not such a bad deal. But what most people don't realize, Frank, is that when you're in that 12% or less tax bracket, your capital gains rates are zero. That's really critical because a lot of people have qualified dividends and long-term capital gains. And if they pay zero tax on that, again, it's what you keep, not what you make. That's really like, just a great opportunity being in that 12% or less tax bracket.
And that brings us up to the L a little bit. I'm going to step forward here because we seem to need more planning, tax management type planning, preferably in this area, because one reason it sticks out here, Charles, would be you just hit on capital gains. The capital gains rate in the yellow or gold, however you see that color, would be 15%, correct?
15%. Yeah, that's correct. And
Correct.
and Frank, let me just interject here. I mean, 22% versus 12, that's like an 83% increase.
That's a great point you just said there. In other words, I know we calculated that recently. If you were to maximize your taxable income at the very top of that green zone, the most tax you would pay, we calculated, would be for a married couple, using your 120 example, would be a little over 8.5%. All right. And for a single person, just cut that in half and 60, just to keep simple math right now. It would also be just a little bit north of 8.5%. That would be your effective tax rate, correct?
Correct. Effective tax rate is what every dollar gets clipped on in terms of taxes.
Correct. Now we get to that dangerous zone. Really quickly, the red would be considered bad. I think obviously there'd be some limited deductions there. Anything else that sticks out about the red that you don't like?
Well, I would just say if you're in the red zone, you really should have got planning done yesterday. I mean, really most people that we meet, they're in that middle zone, 22 to 35. And over time, we get them down into the 12 or below. But the 37, I mean, obviously they're making good income, but, there's always a solution, no matter what your tax bracket is.
Correct. And I think you've even pointed out before, you're already, if a lot of that's, let's say, in investment income, you also have that penalty I may have mentioned real quickly earlier of the 3.8%. You add that to the 37, that would be 40.8, which would be higher than before the tax cuts of 2017. Correct?
Right. Exactly.
So that's a big part there. So let's also just ask real quick, how should we apply this from a cash flow standpoint? Because that's something you teach and you really understand the law of wealth optimization, knowing that cash flow is really what retirement's about. So let's just take a quick look while we're on this measuring cup right here. It seems like the most optimal way, I would think here, to apply taxable income, which would be your Social Security, pension, or IRAs, would be in the green zone. Would that be the first place we should take the money?
Yeah, absolutely. I mean, green zone, green is good. I mean, for the most part, we talked a little bit earlier about 120,000 married couples still being in the 12% bracket. What I love about this slide here is that red line. If somebody needed more than 120 grand, as long as they have a certain portion of their investments in a tax advantage funnel, you can pull out whatever you want. It's not going to affect, you getting into a higher tax bracket.
Correct. Even in some situations where again, I learned this from you as well, where some people living off of just less than $100,000 married couple again, where we would take the extra 20,000, pay low tax on that, and use some of that to even pay the taxes on a future Roth conversion, or to use it to overfund, let's say, life insurance, for instance.
No, it's a great idea. I mean, 12% tax bracket, it's probably not going to get much lower than that. Taking it out, having future growth tax free, leaving, the kids or surviving spouse tax free, access to income. I mean, that's definitely a win-win.
And since I'm not done beating up the red zone again, I have to remind people, I said earlier, the investment tax penalty, you don't have the 20% small business income deduction for a lot of people who are self-employed, have an LLC. And the worst is, and I know you'll agree with this, I know I'm preaching to the choir here, is having a lot of your pension distributions and your IRA distributions, even required ones in some cases, that are taking you up to that red zone. That means you're really starting to value your own retirement accounts during a time when living costs are rising, volatility obviously will continue, and taxes, as we stated here, have to rise because of the math, right?
Yeah. Well, I mean, when I look at returns, and I see income on people's returns, like dividends, interest income, I always ask, are you spending this? And if they're not, I mean, I had this like kind of thought that, hey, why pay taxes on money that you're not spending? There might be like other opportunities to maybe like get that off the return, put a Roth conversion on there, pay the same tax, but now you got future tax-free income as opposed to just, every year paying taxes on money that you're not spending. Kind
But
of
again,
irritates me.
once again, you're thinking like a chess player. And just so you know, people out there that are stuck with pension and they have taxable income that already takes them in a high tax bracket, there's hope there because once again, we can still attack the marginal rates. I'll just show you the quick example here. I'll explain. Here's a high net worth scenario where we were intentionally able to keep the effective tax rate under 20% because each dollar earned above this number, it would be taxed at 32%. So just so you know, this case involved a very much needed Roth conversion in order to divorce the IRS from a good portion of their retirement accounts because these older people still had longevity and they cared about family wealth transfer. And they wanted to be able to stay at the lowest possible effective rate. So this type of planning has further resonated with people wanting to obviously, at least minimize the tax damage that they feel like they're stuck with. Any thoughts you have there?
Yeah, and then one thing I want to mention is when people do this, and we have quite a few people that do it each year. They're once they're over 65, their Medicare premium will increase. So I get some pushback on that, but I say, look, I'd rather you pay the Medicare premium increase for 3 to 5 to 7 years rather than paying that for the rest of your life. So that's just like a hidden tax, that Medicare increase. But believe me, like when you look at tax management over their lifetime, it makes perfect sense to do these Roth conversions for most taxpayers.
Exactly. I have one or two cases where a high net worth couple here, they have enough cash to live off the first year or two in retirement, especially now that we're still in the lower rates. And I know this year and another one next year, we'll be intentionally doing a conversion close to $400,000 and trying to show that as our only income. And these were people that were getting a deduction of anywhere from 35% at one time to now 37% on the contributions they made. So they're paying an effective tax rate of, in this case, less than 19% on this portion of tax infested assets. That's a great trade-off right from the get-go, correct?
No doubt. Unbelievable.
Again, back to some of the people who really, I always like to say, want to try and pay zero tax, who can arrange that. I know your friend and our other colleague, David McKnight, had a great book and he had a documentary on the power of zero, how anyone, like in some couples we know where the wife loves avoiding taxes and the husband just hates paying them. So there's people that don't want anything to do with the IRS. But to make that clean divorce, I know many of them even asked you, hey, can I just convert all of this? They don't mind paying whatever it takes to divorce the IRS because they understand some of these things are happening. Would you agree with any of them that ask you, can I just remove all of it from the IRA?
Initially thought that, yeah, let's remove all of it. That was my thinking. But then when I really learned about this 12% tax bracket, how powerful it was, we can just get people in the 12% bracket and they're not going to pay much tax at all. Here's a good example, this next slide. So if somebody had 400 grand, they're single in their IRA account. As a general rule, once you hit your required minimum distribution age, you got to take out roughly 4%. So 4% of the 400 grand, 16 grand. If their standard deduction's close to 16 grand, I don't mind anybody paying tax on $300. So to your point there, Frank, yeah, you don't have to clean it down to zero. $400,000 seems to be a good number for somebody that's single. But I will say that, everybody's different. People might have pensions, so their number might be a little bit different. And even though married people, it's twice the amount because obviously, their tax situation is more favorable in terms of the IRS, the rules and regulations. I like over time they get even the married couple down to 400, knowing that probably one's going to predecease the other, that type thing. But again, you don't have to clean it down to zero. If you're married, 800,000, then phase two, get it down to 400. And if you're single, 400 is a good number.
Right. And when people are asking about, well, okay, future contributions, should I do any conversions? What do I do? If let's say they're, whether it's single or they're a couple, they're very young, maybe in their 30s or 40s, and they're, let's say, in a low tax bracket and they have $1 million hypothetically already in qualified assets and pensions. Would those people be you want to steer them completely towards Roth contributions and even Roth conversions to wherever they can?
Absolutely, definitely. I mean, realistically, what keeps me up at night is like young people that have a lot of money in their qualified accounts. The rule 72 says, hey, at 7%, money doubles every 10 years. Well, what's it going to be when they retire? $1 million could be $4 million without putting another nickel in there. So, they need to really like, address like, hey, current contributions should really be shifted to Roth IRAs or Roth conversions, and they should do it sooner rather than later, in my humble opinion.
And conversely, there's another older married couple near retirement that we know that was almost like too tax efficient, if that's possible. With them, it was almost a reality there because they're in a high tax bracket, again, near retirement, and they only had 300,000 of their high net worth in qualified assets. And they were all excited to get that $300,000 over and do more Roth contributions. I said, time out there. I said, no. I said, and you would agree with me, right? I said, make maximum 401k contributions because you'll be able to control your cash flow and take, again, here, 32,000 or a little bit less to offset your standard deduction. So you get a 37% write-off on that portion that you'll pay zero tax.
Yeah, that's perfect. Obviously, if their account balance is well below the 800, obviously they want to take that current tax deduction today, fund it as much and quickly as possible, and forget about the Roth conversions. I mean, you're right on point.
And for a lot of those people where their 401k, for instance, or 403b is a big part of their future wealth building, that again, they got to be able to manage effectively and avoid having too much in that pre-tax funnel that you were explaining earlier. One thing I remind people, and I even remind myself when I pop this up, is to always check with your service provider, get a plan summary description just to let you know what your flexibility is. I'm sure you agree with this in case people can more customize their allocation better, in case there's portability options to help them do their own, more customized Roth conversions, and also any overall estate plan and flexibility that may exist by knowing what your choices are in your 401k. Does that sound
Yeah, I think it's
with
great.
you?
It's nothing bad or wrong where people's money is currently, but when they have the opportunity to maybe, move it somewhere else, then they have the universe of investments rather than just the specific investments that are, privy to their plan.
Correct, correct. Now let's move to uncover some of the, hidden tax traps here. Okay, we'll walk through I think was almost a perfect example. Here's someone in a 12% marginal tax bracket. Why? Because they have 60,000 marginal income, 60,000 capital gains. That part I think would be tax free. So they owed 6,400. Then you added an extra $10,000 that are to the other 60,000 capital gains. Now your liability was $9,112. That's a $2,700 jump in a 12% marginal bracket. So I almost have to say time out there and almost do an instant slow motion replay like they do in NFL playoff games when they have to decide on getting a call right. And let's walk through this again because this has happened in real life before, where even I've told someone in a case just like this, yeah, you owe 1,200, and I thought I was a smart aleck and I knew it all. And I didn't really, in this case, look at their tax return, which is like a doctor looking at an X-ray. I would have figured it out real quickly, just like you always do. So if you had that extra $10,000, again, let's hit on that. Charles, can you explain that? Yeah.
Yeah, so basically, in the first example, you only had 60,000 of ordinary income. Now you have 70. Ordinary income gets taxed first before capital gain, right? So now, basically, we're paying 12% on the ordinary income, but the capital gain, now we've got 15% of that is going to be taxable. So 15, plus 12 is 27%. So just $10,000 of more income created $2,700 tax liability.
Another great example where you have marginal tax traps, and where those tax traps can hit you really is sometimes your taxable income can then increase again to the 22% marginal rate if it's all ordinary income, right? And
Absolutely.
another thing that can happen is you can run into provisional income problems, which affect the tax on Social Security. And what I mean by that is another thing you preach really well is that there's three forms of income in retirement besides ordinary income and capital gains we're all familiar with. there's provisional income. All right. And we'll just take a moment and just walk through how that works, Charles, in case you have any comments here, which
Yeah,
is
so the rule with provisional income is they take all your income, your tax, even like income on tax-free municipal bond interest, which isn't taxable for regular taxes. And your other income could be pensions or wages or money coming from your 401k IRAs, dividends and interest, capital gains. They add all that, and then they add half your Social Security, and they come up with a number. So basically, the way I look at it, half your Social Security plus all your other income equals your provisional income.
and let's jump on the thresholds while we're at that. I know you deal with this around tax time every year when people sometimes find out that they may be subject to possibly owing more than they expect. And I know you always want to prevent that. Let's go over those thresholds if you want to comment on that.
Yeah, so if you're single and your provisional income is less than 25,000, none of your Social Security is taxable. If it's 34, between 25 and 34, up to half your Social Security is taxable. And if it's over 34,000, that provisional income computation, up to 85% of your Social Security is now taxable. And that's a single person. Let me just tell you a quick case. Well, a case I worked on. It wasn't a quick case, but a woman came in and she had, an opportunity to either, take a pension for life or a lump sum and then create her own pension. And I remember asking her, I said, do you want to pay taxes on your Social Security for the rest of your life? And obviously she said no. If she took that pension based upon the amount of that pension, her Social Security would have been taxable for the rest of her life. What we did, Frank, is we rolled it over to an IRA and over a period of time rolled that to a Roth IRA, then created a pension. And now for the rest of her life, her Social Security will not be taxed. So again, tax management versus tax planning, like really critical.
That's a great example. And the same with the married couple, right? It
Yeah,
jumps.
the married couple, same concept, but the thresholds are different. If original income is 32,000 or less, none of it's going to be taxed. If it's between 32 and 44, up to half it'll be taxed. And anything over 44,000, up to 85% will be taxed. So the way I equate it is if 85% of your Social Security benefit is taxed, it's kind of like giving like 1.5 to 2 Social Security checks back to the government, and again, some people are forced to do that, but with proper planning, maybe, that can be, reduced and or eliminated.
Yeah, and I know sometimes these Social Security limit thresholds can cause people in a 12% marginal bracket to jump up to the 22 for each additional dollar of taxable income, which you said earlier is the biggest jump in the tax code because that's an 83% increase in your tax rate.
Exactly. They call it the torpedo tax. It just like, it just zings you. You don't even know it's coming. And before you know it, hey, how come I'm paying all this tax? Well, basically the provisional income, created like much higher taxes because you weren't aware of it.
And I have to agree with Torpedo because I've seen situations where people in a 12% marginal tax rate bracket ended up with all the other penalties, the Medicare tax and things like that, end up paying close to 40%, tax rate on just having all these provisional income issues pop up, along with some of the other traps, including higher marginal rates and capital gains now being taxed. There's a lot of moving parts that can get hit at once.
Yeah. Well, that's why I love that funnel that you showed earlier. Like, having things in the right place per individual could really like maybe minimize this tax burden.
Right. And here's a quick example, let's say, of another trap where it's a sad one where it's losing a beloved spouse because three things happen. One passed away, they lost a portion of Social Security, that was a lower amount. They needed to take another $10,000 from the IRA balance, and they ended up paying more in taxes, which seems kind of strange. And you might want to just share that real quick, what really happened there. I think it's another great reason why it makes so much sense for people to plan proactively. In this case, maybe even use a little bit of the income for pennies on the dollar to have a 10 or 15-year term life insurance policy, knowing that, as you alluded to earlier, if you file single, you can get hit harder with taxes and you don't want your cash flow to be disrupted. Any thoughts there?
Well, I mean, obviously they needed about 60 grand when they were a married couple. It seems like the surviving spouse needs 60 grand, but they lost a Social Security check. So now they got to take some extra money out of their IRA. And again, provisional income, capital gain, ordinary income, that creates like, this, unbelievable tax of 5357 as opposed to a little less than $1,000 when they were filing a joint return.
The next tax trap, I'll just cover real quickly. We want to be able to now compare tax sensitive assets. All right. And again, as you can see here, it gets better to the right and worse on the left. All right. The worst obviously would be the 401k, pension, interest income, and the best could be tax exempt income. All right. Even if the yield's a little bit lower than you would in the taxable area, the Roth IRA, cash value life insurance. So I think, Charles, the more you are to the right, the less effective, the income can be on the left, if you balance things out, at least, in other words. So if you're overweighted to the left, as we've alluded to, you're in trouble. Would you agree with that?
Yeah, and I would just say, like, again, if you're in the 12% or less tax bracket, everything to the left doesn't really like ding you that hard. So, the key is first, what kind of bracket you in? Let's get you in the 12% tax bracket. And then the interest income is not going to be that crazy because, I still get to keep 88%.
Correct. Excellent. And the next one, another one real quick, is plan gifting. I know we're going to move along here. We're covering a lot in a short period of time, as we promised. And these are some of the easiest strategies that can practically be done from the get-go. I'm just going to just share each one here real quick. First of all, for especially high net worth clients, they can use some of their unified credit, number one, and gift to family members in a lower tax bracket. So that way their income earned is paid at that lower level. I think that makes a lot of sense, right?
Absolutely.
Donor advised funds. All right. Here you can take a perfect example would be somebody near retirement. I have in a high tax bracket. They love giving $20,000 a year to charity. It'll continue doing that. They can. The cash flow will support that. But I'm looking at this saying they're hardly getting any deduction. Only $600 they're able to deduct as you look on the tax return, right? And I think that's a little bit of a problem. So I said, listen, if you're already committed $200,000 over the next decade, let's give at least $100,000 that we can, discretionary money, into the donor advised fund. We can make those gifts any time we want over the next decade. We control the terms, and you get that tax deduction, right off the get-go. All right.
Yeah.
And I also like them for offsetting and you've taught me this, a large Roth conversion. All right. If, let's say, you're doing the 400,000 one we talked about earlier, and then they did the full 200, then they can offset the taxes on half that conversion that would have had them in higher tax rates. So that's a good offset. A lot of nice flexibility there. What do you think?
Absolutely. No, absolutely. I mean, donor advised funds are, we have quite a few clients that just love to give to charity, but they're not deducting on Schedule A, their itemized deductions. So, why not get a bang for your buck? So basically setting up a donor advised fund gives you the opportunity to go to this particular fund to write the checks to your favorite charities. I think it's a win-win.
And we have people at retirement distribution age, just to remind you that they want to get 100% direct deduction on some of those IRA withdrawals they have to take, so they can transfer that directly to a charity. And I know that limit, I think now, is 105,000. They can do up to that, even if it's 20,000 again. And they're going to give 20,000 to, let's say, in RMDs, for instance, and they're going to give 10,000 out to charity. Just to remind everyone, the first $10,000 in the beginning of the year, whenever you take that, has to first go and be transferred directly to the charity. Don't just gift other money and from the IRA distribution and then give the charity later that year. That's a mistake some people have made when they haven't done tax management. All right, does that make sense?
Yeah, no, you got to take your RMD first. You're right.
Right, exactly. And there's also some great advanced charitable planning techniques using charitable remainder trusts. We don't have time enough to expand on that here, but we may cover in a later segment, which would also be fun as well, which gets us to the next one, which is pay now, pay later. I know we talk about this a lot. I'll just touch it real quickly. We're going to look at a modest example of a qualified account that was intended for lifetime income and wealth transfer. All right. And keep in mind, if you're the IRS, they want to see you grow and delay as much wealth as possible. So they can maybe take 30 to 50% instead of maybe 10 to 20%. So they're kind of smart. When you saw earlier, they pushed back those required minimum distribution ages. They weren't doing that for us. They were doing it so they can have more money later.
Absolutely.
And this was a mild example, Charles. They were faced with a choice. I say mild because this could have gone either way. All right. Where they expected to live to age 90, pay 25% tax, on the $500,000 of IRA money. All right. And they knew a Roth conversion, would have obviously cost them 125,000. They would have paid 25% of a $500,000 up front. It turned out the taxes of those RMDs plus the taxes to transfer wealth at death, a good estimate of that would have been a little over 300,000. So in this case, it could have gone either way based on the time value of money. But I want to be mindful, and I know you preach this as well. The most incredible opportunity for people out there that take tax-infested money and make it forever tax-free is if you have a long time horizon, you have higher long-term return potential, you have good investments, things like the S&P 500 that have averaged close to the double digits in spite of volatility, and we're going to face a rise in tax environment. Roth conversions there can be the retirement dream of your lifetime. I'll repeat that. So, because you're buying the IRS out of your retirement account. Would you agree with that?
Yeah, and the other thing too is like we talked earlier on the webinar about, we're in a rising tax environment, taxes are going to go up. I mean, this is probably assuming the same tax rate for the next like 20, 30 years. So, the stake should be the difference between 311 and 125 could be a much wider gap.
Correct. Absolutely. But I think people get the gist of that. And that gets us to the last and most important step. And this is where it all comes together, in my opinion, because again, we're managing our dynamic tax bracket. All right. And just to make it easier, we're going to take a quick look at the bucket plan, Charles. Just walk us through it real quick because this is the one case where we're really bridging, actual tax management with what I call wealth optimization, which is optimizing your wealth for distributions to make sure that your money outlives you, you don't outlive your money. All right.
Right.
With that said, just tell us a little bit about the now, later, and soon bucket.
Yeah, all right. So the bucket plan, I love this bucket plan. I was introduced to it years ago, and everybody gets it. It's very simple. But I'll start with the soon bucket because that's kind of the missing piece with a lot of people's plan. They don't have a soon bucket. And if you get that number right, Frank, not too high, not too low, just about, what you're going to need, it gives you permission to put, the remaining monies in the later bucket for growth and legacy. And generally speaking, the later bucket is more equity than non-equity. And, obviously there's volatility. People are concerned about it. But when you're buying yourself, say, a 10-year time horizon, volatility becomes your friend, not your foe. And, what we've seen in our practice, and I'm sure you've seen it in yours, is that when their equities and their qualified accounts go down in value temporarily, we're pouncing on that, trying to convert it to a Roth IRA to pay minimum taxes. And that could be an advantage, market volatility, as opposed to a disadvantage, what most people think, market volatility is. And then, the now bucket is money that's safe and liquid. And look, we have to have an emergency fund. Hey, maybe we're going to buy a new car in the near future. Maybe there's gifting to some of the children or grandchildren. So the now bucket is money that's safe and liquid. The only downside I would say to the now bucket is if you're overfunded in that, you're not going to keep up with inflation. So as a general rule, now bucket, hey, you're not going to keep up with inflation. The soon bucket, you're going to spend down and probably will keep up with inflation. And the later bucket, if history's any guide, will beat inflation if it's involved with heavily involved with equities. So I love this bucket plan concept. Clients get it. I know you're schooled in it. What are your thoughts? Anything that?
I love the fact that you separate these based on timelines and so forth, because as you suggested there earlier, it puts you in a position, no matter what's happening out there, you can respond positively from a cash flow standpoint to make sure you're optimal, where you can not only not get hurt, for instance, by volatility, but you can benefit from it, whatever's happening, because your essential expenses are already covered in the soon bucket. So when you have a time horizon, you can benefit from the fact that equities market, for instance, is always declined, recovered, and set another record.
Right.
Right. And it also reminds me that as taxes are important, but we don't always want the tax tail to wag the economic dog. So that's why, as I said earlier, wealth optimization and tax management coming together is just a dynamic approach. And thank you for that. And that gets us to the tax part of it. I'm just going to walk through this real quick. Here's a case where they were combined for a couple that lives off $150,000, and I give them the credit because they were so proactive. They were even bugging me ahead of time. And I was sometimes just responding to their requests before I even said anything. All right. So we'll look here on the in the pre-tax, we go to the soon part of that bucket, right? We
Yeah.
got Social Security and IRA, that's total of 90,000, right? We're
Okay.
still in a low tax bracket, correct?
Absolutely.
All right. Now the next portion of that income was 10,000 in cash. Why? Because we had plenty of emergency reserves that we didn't need, so we grabbed 10,000 from cash. We withdrew some of the income from the tax-free munis, 8,000. So that was tax-free, correct? Even though it increases provisional income to some degree, we still
Yeah.
don't pay an income tax directly on that, correct?
No income tax on the tax-free municipal bond interest. No.
And your other favorite is the 12,000 at capital gains because they had this appreciated Merck stock, I remember at that time, overly appreciated almost. So we started taking chunks of capital gain withdrawals, in this case, 12,000. That's in a low tax bracket. So in that green zone, they're paying zero tax on that, right?
Zero tax in the green zone. That's correct.
Wow. And again, the Roth IRA, they wanted to convert everything. We had told them only to convert half. All right. So there's 24,000 right there, tax free. And life insurance, they were funding some life insurance with the long-term care rider, which was very smart. So they want that asset base to grow even more, not take too much out, preferably, because that'll transfer best. Based on that 150,000, I saw that on the tax return, just so you know, to save time here, there was $4,150 owed. That's it. You divide that by 150,000, that came out to an effective tax rate of 2.8%.
Wow.
So if taxes were to double on this couple to 5.6, because IRS does need to double taxes to have any way of our country becoming solvent again, and that comes from the Congressional Budget Office. Do you think this couple would really be hurt badly by paying 5.6% effective tax rate?
No, they continue to keep 94% of every dollar. They're going to be happy.
Very, very, very happy. But the ones that aren't happy are some people live off of less that keep saying, why do I keep getting hit over the head? All right. And you have a good answer for that. Just tell them real quick.
Yeah, so two systems of taxation in our country, one for the informed and one for the uninformed, plain and simple.
I love that. And this judge actually has been in a lot of appeals cases, and he's seen why people lose. Well, we don't want anybody listening or watching this to be, a victim in that case. And again, let's, take a quick look at, how people will feel. I know feelings are important. How much better will people feel if they know, number one, they can avoid any more tax traps throughout their lifetime? You think they feel good?
They feel great, they would feel fantastic.
And as you've done often, you've converted some of the dangers in the tax law into opportunities. We gave some examples here. Do people feel good about that?
You know what? Take your emotions out of your investing, feel good about your resources because you're tax efficient. Nothing better than that.
Excellent. And of course, we can all agree to get control of your income and assets instead of the IRS. I don't know anybody that comes in either of our offices that just loves the IRS or has any loyalty to anyone there. Do you think people are happy with that?
Absolutely. Control is key.
Absolutely. And one of the best things to do, I always have to remind, I never like to leave the sight of anything, any goal, especially something this important that affects people's lifetimes. I think the issue of whether you're going to outlive your money or money's going to outlive you is affected by taxes, as we talked about with Ed Slaughter earlier. And you always like to never leave without some initial action. And this is a quick one. It's just a little free survey, not on us, but on people out there watching. All right. Take a picture if you can. So that way, if you have to print it out, whatever you need to do, and rank some of your biggest potential tax, financial, or wealth transfer concerns, even from 1 to 5. If you want to try and speak to one of us for 10 or 15 minutes, possibly, just mark down some of your best times. We'll definitely make every best effort to try and get back to you right away. We can't promise anything. The sooner it gets there, the most likely that can happen. But at the same time, I'm just very encouraged for people out there that want to make their situation better. Please feel free to reach out to us. If you have an advisor or a tax attorney you really love, then use some of what we shared and ask him. But we just want to see you get some momentum in this crucial area. And as mentioned before, Charles, I just want to get your opinion on this. We talked about that bucket planning process, all right, as we wrap up here. I know we've done a master class that really concentrates a lot on the bucket plan. It's called the 3 Most Crucial Retirement Risks. All right. Do you have any quick thoughts or opinions on what you think, whether people should watch this or not?
Yeah, I mean, I'll tell you, I love that. I love the that webinar, how to limit your 3 most crucial retirement risk. I mean, as you and I well know, Frank, there's 18 of them, and the three of them that we kind of like concentrated on are so powerful that once you really eliminate them or address them, the other 15 really are not that relevant.
And another asset class people were curious about here when we talked about life insurance. Well, it all starts with understanding how life insurance works and long-term care as an asset class. It's often by Ed Slott considered the second greatest benefit in the tax code. I consider it also the most misunderstood and misutilized asset class out there. And being able to bridge that is a real game changer. I think you and I are going to be presenting something, I think, along the way with the Estate Planning Council of Philadelphia to share with some of the other estate planners and tax attorneys that are part of that great association.
Yeah, no, I'm definitely looking forward to that. Life insurance as an asset class is an unbelievable topic.
And on the survey, people can ask for a future invite. All right. So while we, of course, jump to the most exciting stuff and being a little facetious there, we just want to be able to make sure we disclose for everyone the importance of maintaining the highest ethical standards. Charles, you're a great example of that, among with some of our other colleagues. And this includes protecting you from any self-made motivated sales practices, other financial entertainers, and the overwhelming amount of incompetent advice and otherwise well-intended opinions that come from other sources, even some family members. All right. And we also included some of your disclosure with PCA, Prosperity Capital Advisors. That's a great outfit. I'm really proud you're associated with them. And I know some of our friends from Clarity to Prosperity, I highlighted earlier, they offer a special, I think it's a two-day program to teach some other proactive advisors in this area so they can understand how to bridge tax management.
Yeah, I mean, definitely Prosperity Capital Advisors are committed to changing the way America invests. So, there's no doubt, great organization, same as your organization there, Frank,
And
Madison and Maine.
and thank you for that, by the way. So on behalf of all of us, including Madison Maine Advisors and our special guest here, Charles, any closing thought?
It reminds me of a story. I'll kind of close with this comment because it's part of our marketing. My mom, well, my brother, I have like 10 brothers and sisters, and one of my brothers asked my mom after my dad died, hey, you have any secrets for us young people? And my mom looked at my brother and said, Johnny, it's later than you think. And those words, there's no truer words spoken. I mean, anybody on this webinar, I don't care what your age is, you only have today. So it's later than you think. So if some of this information percolates with you, I would, definitely, not procrastinate, so that's my closing thought.
But it's also gotten a little later during this master class, but with all the wisdom, I think that was well worth it. And so I want to remind everyone, stay well and always remember the dangers we continually highlight will be the biggest issue for those who don't plan to act in some way now. That's why we gave you a little incentive, giving you a survey for yourself to rate what's important to you. And that's why we highly recommend just taking some action by, again, ranking those highest concerns for yourself, sharing them with us. We'd love to hear your thoughts on that. But we want to thank you and we look forward to connecting again real soon. So for the time being, bye for now and all the best to you.
Take care.